In less than 48 hours, silver went from printing an all-time high near $121.67 an ounce on January 29th, 2026, to trading around $79.45, a drop of roughly 35%. That kind of move is supposed to be reserved for bankrupt companies, not a monetary metal that also sits inside the guts of modern industry. And yet it happened. Not months, not weeks, but in a window so tight that many people only noticed after the damage was already done. For years, the comfortable assumption was that silver could be volatile, sure, but that it would not behave like a trapdoor in the span of 2 days. They said this kind of break could never happen in an asset this old, this traded, this watched. And while most eyes were fixed on the candlesticks, the machinery underneath the silver market was being adjusted in real time. Collateral rules tightened, risk limits snapped inward. The definition of acceptable leverage shifted overnight. When that happens, the market stops being a simple auction of opinions and starts acting like a stress test. Institutions understand this instinctively. They watch the plumbing before they watch the headlines. If you only look at the chart, it feels like chaos. If you track the constraints, it looks like a system doing exactly what systems do under pressure, protecting itself, even if that protection creates violent price behavior. Here's the part that sounds impossible until you see it up close. A collapse in paper price can happen at the exact same time as a tightening in physical availability. Silver trades in at least two worlds at once. There is the world of contracts, where exposure can be created, scaled, and unwound with a click. And there is the world of bars, where supply has weight, location, delivery rules, and time. When those two worlds drift apart, the market can send two opposite messages at the same time. One message says abundance, another message says strain. And the spread between those messages is where most people get lost. Welcome to Channel Name, where we decode what matters before it becomes consensus. This is the place for people who want to understand what the data actually says, not what the crowd hopes it means. If you value analysis that connects inventory, margins, and institutional behavior into one coherent story, stay close. And if this kind of breakdown helps you see the market more clearly, consider subscribing the way you'd keep listening to a wise elder who doesn't waste your time. Also, drop a comment with where you're watching from, because the silver story looks different depending on what your local market is actually doing. Now let's reconstruct what happened, step by step, without drama and without denial. 67 on January 29th, 2026. A print like that doesn't appear from nowhere. It builds through momentum, hedging, and a rush for exposure. When a metal accelerates, futures markets tend to attract more activity because they are standardized, liquid, and efficient. Efficiency has a cost, and that cost is leverage. Futures allow large exposure with a fraction of the notional value posted as margin. In quiet conditions, that leverage is manageable. In fast-moving conditions, it becomes a trap. Because when price swings hard, the collateral required to hold the same exposure can change faster than most people can react. The next piece of the timeline matters even more than the price. On February 6th, 2026, the CME raised margin requirements on COMEX silver futures. Specifically, COMEX 5,000 silver futures margins were pushed to 18% from 15%. That is not a minor technicality. The 3 percentage point jump in required collateral changes behavior immediately. It forces participants to either add cash, reduce positions, or restructure exposures. And when this happens, during fast volatility, the impact is amplified because the market is already leaning on the very thing being tightened. Leverage. This is where the central mystery forms. Margin changes do not move a market because they change the physical supply of metal. They move a market because they change constraints. Imagine a crowded theater where the fire marshal suddenly cuts capacity. The building didn't change. The movie didn't change. But the crowd must move anyway. Some people have to leave, not because they want to, but because the rules now require it. In futures, leaving means selling contracts, cutting exposure, shifting into options, or stepping aside until collateral is available. If enough participants are forced to reduce at once, the sell-off becomes self-reinforcing. Price falls, which triggers more risk controls, which triggers more selling, which widens spreads, which makes it harder to stabilize. So the real question is not simply why silver fell. The real question is why it could fall that fast while the physical layer did not suddenly flood with supply. That contradiction is the signal. In the paper market, the screen says silver became plentiful in a day. In the real market, the flow of capital and the behavior of inventories can suggest something else entirely. Two data streams, opposite directions, same time. That is what market dislocation looks like. To see why this matters, you have to recognize the historical pattern. Silver has a long memory and it keeps reenacting the same playbook whenever leverage and scarcity collide. In 1980, silver experienced one of its most famous episodes. Prices ran up violently, liquidity concentrated, and then the rules changed. Requirements tightened. Forced selling hit. The result was a brutal collapse that taught a lasting lesson. When a market becomes crowded and leveraged, the exit is not a door, it's a funnel. Fast forward to 2008, the global system seized up. In the scramble for liquidity, silver sold off hard. Not because the world suddenly stopped needing silver, but because people needed cash and they sold what they could. The result wasn't that silver became permanently cheap. Once forced liquidations faded, the metal rebounded as confidence in financial stability wavered and as demand reappeared. Then came 2011. Silver surged, narrative ran hot, positioning got crowded, and volatility spiked. The system responded the way it always responds: higher collateral requirements, tighter risk controls, and a rapid shift in who could hold exposure. The outcome was another sharp reversal. Many observers called it the end of the story. But structurally, it was the same story. Leverage built, rules tightened, the crowd was forced to thin, and then the market began the slow process of finding a price that could be held without constant emergency collateral. And in 2026, it's happening again, with a modern twist. The market is larger, faster, and more interconnected. The paper layer is more accessible than ever, and the physical layer is more global. Participants range from industrial users hedging input costs, to funds expressing macro views, to high-frequency liquidity providers who manage risk by the millisecond. In that environment, volatility doesn't just move price, it moves the entire risk framework across markets. Historically, the sequence rhymes. Price rises quickly and pulls in leverage, while volatility spikes and forces exchanges and clearinghouses to protect the system. Margin gets raised. Some participants add collateral, but others can't or won't, and they are forced to reduce. Selling accelerates. Headlines declare the move proof that the prior rise was irrational, and then the second-order effects begin. Physical buyers who were sidelined step back in. Industrial hedgers adjust their coverage. Inventories start to matter more than opinion again. Now we need to talk about the players, because markets move through institutions, not through abstract feelings. At the center of the futures ecosystem is the exchange and its clearing system. The CME does not exist to predict direction. It exists to ensure performance. When volatility rises, its responsibility is to reduce default risk. Margin is its most direct tool. It is a risk control decision that can reshape the market's behavior in hours. On the other side are the participants. Banks and trading firms provide liquidity, hedge risks, and arbitrage differences across venues. Funds hold directional exposure, sometimes hedged, sometimes not, and often constrained by risk limits that tighten when volatility rises. Producers and consumers hedge operational needs, but even hedgers can get caught by margin, because hedging is not free when collateral requirements jump. Each group responds differently. The important part is timing. When a rule changes abruptly, whoever is most constrained has to act first, and their action becomes everyone else's price signal. Then there are the structures adjacent to futures: exchange-traded products, regional physical markets, and vaulting systems. These are the bridges between price on a screen and metal in a vault. And this is where institutional movement becomes visible if you know what to watch, because the physical layer leaves footprints that speculation cannot fully erase. Consider a hard data point that cuts through noise. 16 lakh crore. That is a flood of capital-seeking silver exposure through regulated vehicles. It matters because it signals persistent demand even as volatility heats up. It also matters because India is not a small side market in precious metals psychology. It is a massive pool of household and institutional demand, and its flows often reflect broader fears about inflation, currency stability, and real purchasing power. Now place that next to another hard number from the physical custody network. 3% month over month. 3% feels small. But direction matters, especially when price is volatile and attention is high. In heavily financialized metals, inventory is like oxygen. You don't notice it when it's plentiful, but you notice the moment the room starts getting thinner. A steady drift lower tells you metal is leaving the system faster than it is being replenished, or at least that net outflows are winning. Put those two data points together, and a specific institutional picture emerges. While paper positioning was being forced to compress by higher margins, major investment flows were still moving into silver exposure and size, and a key Western Vault hub showed net holdings edging lower. That combination is how dislocations are born. It's not one dramatic headline. It's the mismatch between forced selling in the paper layer and persistent demand and draw in the physical layer. Now let's name the dislocation clearly. 45 suggests sellers overwhelmed buyers, and liquidity was sufficient to clear at dramatically lower levels. In the physical ecosystem, demand indicators like ETF inflows and the persistence of inventory, pressure suggests appetite has not simply disappeared. Those are opposite signals. Why can that gap exist? Because a futures price is not a direct price tag on a specific bar in a specific location. It is a standardized contract with delivery rules, warehouse categories, and timing conventions. Most futures contracts never go to delivery. They are closed out, rolled, or offset. That means futures can experience extreme price moves driven by positioning and collateral dynamics, even when the physical market is merely tight, not collapsing. The contract is liquid, the bar is not, so the contract can be dumped in size without moving a single ounce, and the price can fall faster than physical supply can respond. This is also where experts contradict each other in public, and both can sound confident. They can both be reacting to real data because they are looking at different layers of the same market. The mistake is assuming the paper layer and the physical layer must always match in real time. They often don't, especially during forced deleveraging, but dislocations can't persist forever. Either the physical market loosens enough to validate the lower paper price, or the paper price re-anchors as physical constraints reassert themselves. Historically, when a metal has dual demand, industrial and monetary, the physical layer tends to reassert itself after forced liquidations end. That does not mean the market owes anyone a straight line. It means the market story must eventually reconcile with inventory, delivery pressure, and real-world demand. Let me explain the mechanism in a way that makes the chain of cause and effect obvious. Think of the silver market like a river system. Futures are the wide, fast channel where water can surge or drain with a storm. Physical inventories are the reservoirs. Margin is the dam control. When the dam settings change suddenly, the flow in the fast channel can whip violently. That doesn't instantly change how much water exists in the reservoirs, but it changes who can access the channel and at what cost. During stress, the fast channel can drain even while the reservoirs remain constrained because selling contracts is easier than producing metal. Now apply that to early February 2026. Price volatility surged. The clearing system responded by raising margins from 15% to 18%. Participants near collateral limits had to act. Some wired in more cash, but many reduced exposure because reducing is faster than moving new collateral, and because mandates and risk committees often restrict sudden expansions of margin usage. That wave of reductions pushed price down quickly. The speed triggered additional risk controls, which triggered more selling. The market did what it always does under mechanical stress. It pushed prices to levels that clear the most urgent pressure first. Meanwhile, physical demand does not automatically switch off. Industrial users still need silver for manufacturing cycles, solar, electronics, and chemical processes. They may hedge differently, but the underlying need doesn't vanish in 48 hours. And investors, particularly in markets that treat precious metals as a core store of value, can view sharp sell-offs as a chance to accumulate exposure at lower prices. That's why the figure of 9,563 crore in ETF inflows matters. It suggests that even as paper pricing was whipping around, capital was still choosing silver. Exposure in size, not as a rumor, but as a recorded flow. And this is where the phrase shortage confirmed needs to be handled carefully. Shortage is not always a single dramatic moment where shelves are empty. In commodity systems, shortage often appears as friction, longer delivery times, higher premiums, reluctance to sell physical inventory at paper prices, inventory drifting lower month after month, more metal moving from one region to another. The market can look liquid on screens while being tight in the pipes. That's why the LBMA number matters as more than trivia. 3% month over month is a signal of net outflow. In calm times, small moves are noise. In stress times, small moves are clues. Because if price collapses and inventories do not surge upward, it raises a straightforward question. What exactly was dumped? Was it metal, or was it paper exposure that can be created and destroyed without moving a single bar? Here's where it gets interesting again. The silver market can trade enormous notional volume compared to the amount of metal that changes hands physically. That is not inherently bad. It provides hedging and price discovery, but it creates vulnerability. When confidence is high, paper claims are treated as close substitutes for metal. When volatility spikes and holding paper becomes more expensive, the distinction between exposure and availability becomes sharp. That distinction is where dislocations live, and it is why a big down move in futures does not automatically prove that physical conditions are comfortable. There's also a delivery dimension that most people never consider. Warehouses can hold silver, but not every ounce is equally ready to meet contract delivery. Some metal is eligible but not registered for immediate delivery, meaning it exists, but it is not committed to satisfy futures obligations without a deliberate change in status. In calm markets, that nuance feels academic. There is a geographic dimension too. Silver is consumed and accumulated globally, but the benchmark price often comes from specific futures hubs. When conditions tighten, metal can flow toward where bids are strongest, and regional conditions can diverge. Sometimes, physical premiums rise in one region even as the global benchmark falls because the benchmark is reflecting forced selling of contracts, not an abundance of bars in that particular place. When you see those mismatches, you are watching the market admit quietly that not all silver is equally available at the same time, at the same price. So what does this imply going forward, based on pattern rather than prediction? It means the next phase will be determined by whether forced selling is finished and whether the physical layer continues to show tightness or begins to loosen. Historically, after a margin-driven crash, the market tends to evolve through one of three pathways. In the conservative pathway, volatility cools, margins stabilize, and price grinds in a range while inventories and flows determine the next direction. The indicators to watch are the steadiness of open interest, the absence of repeated emergency margin hikes, and a flattening of inventory declines. If the plumbing calms, the market stops panicking and starts accounting again. In the moderate pathway, physical demand remains firm while paper positioning has already been washed out, allowing price to re-anchor higher as liquidity returns and participants rebuild exposure. The indicators to watch are persistent inflows into regulated vehicles, stable or falling volt, inventories, and normalization of spreads between related instruments. When the easiest sellers are gone, price becomes more sensitive to real demand. In the aggressive pathway, a sustained divergence between paper pricing and physical availability becomes visible as higher physical premiums, tighter availability for immediate delivery, and increased focus on warehouse categories and delivery behavior. The indicators to watch include unusual inventory movements, abrupt changes in how metal is categorized or made available, and repeated tightening of collateral rules as volatility returns. In that environment, the market begins to care less about the smoothness of the chart and more about the hardness of the metal. Notice the common thread. None of these pathways require a heroic narrative. They require only a system where leverage is purged, and then the remaining participants have to deal with what exists physically. That is why margin policy is so important. It governs the speed and violence of the paper layer. But it cannot create metal. It can only change who holds the claims and how expensive those claims are to maintain. And that brings us to the evidence-based conclusion. Not a promise, not a forecast, but an interpretation. 45 was a stress signal. The February 6th margin hike to 18% from 15% was a system response. 16 lakh crore was a demand signal. 3% on the month was an inventory signal. Put together, they describe a market where paper liquidity can collapse faster than physical reality, can adjust, and where the most important story is the gap between the two. This is the divide that matters. Most people interpret a crash as a verdict on value. In leveraged markets, a crash is often a verdict on positioning. It is not about being smart. It is about knowing what kind of event you are watching. If the event is primarily collateral-driven, the move is partly mechanical. If the event is supply-driven, inventories and delivery pressure will confirm it quickly. The way you tell the difference is not by arguing online. It is by watching the indicators that institutions track, because those indicators measure constraints, and constraints are what force outcomes. Institutions move first because they are plugged into the plumbing. They see margin policy, funding conditions, and cross-market correlations. Retail moves last because the only signals offered are the headline and the chart. That's not a moral judgment, it's a structural reality. And structural realities create information gaps. Over time, those information gaps tend to become wealth gaps, not because of secret knowledge, but because of attention to the variables that actually force outcomes. So when you hear silver shortage confirmed, translate it into a more precise set of questions. Is the physical layer tightening relative to the claims being traded? Are inventories drifting lower while demand vehicles absorb exposure? Are rule changes like a margin jump from 15% to 18%, creating forced price moves that temporarily obscure physical conditions? If those questions are answered honestly, the story becomes clearer. Not simpler, but clearer. The silver market is not just a price, it is a system. And systems reveal their truth under stress. The headlines will chase the last candle. The data will show the structure. The question isn't whether volatility can return. The question is whether the structure will be understood before the next wave of forced positioning makes it obvious. This is Channel Name, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. Because the real divide is never between optimists and pessimists. It's between people who watch noise and people who watch the machinery.